and welcome. You're watching Closing Trades on ET Now. At market's highest point, that's how we're entering the last leg of the trading session today. Almost a 200-point recovery from the lowest point of the trading session, staring almost at that 17,080 markets. Reliance, which is doing the heavy lifting today, almost one-third of the gains have been provided by Reliance itself, which is up over 2%. However, a bit of a worry coming in from the broader markets because they continue to underperform massively. In fact, the small cap index is down over 1% and the market breadth is quite bleak. Having said that, it's the large caps which are clearly doing the heavy lifting today. It's the year-end adjustments as well as the F&O expiry which seems to be playing on mind of the Dalal Street. And talking about those large cap gainers, Pharma is of course one of the top sectoral gainers today, led by Sun Pharma as well as Lupin. Of course, stock specific reactions coming in there, and banks are also seeing some sort of short covering. So large banks are doing quite well in the trading session today. You have names like IndusInd Bank, which is quite active. HFCL Bank is also supporting on the upside with a gain of around 1%. So a lot of pockets doing well, Nikunj, at this point of time. However, surprisingly, market breadth is quite weak. 1% cut for the small cap.
Markets are highest point of the day, and you've got a little bit of support which is coming from global markets as well. So net, it's turning out to be a decent day of trade. The breadth is something which is just not chipping in. But typically the breadth of the market will only stabilize if you see one or two good days for the Nifty. And I think that is evident. So closer to 17,000, yes, there is a line in sand called a support. Closer to 17,250, 17,300, this market is running into resistance. What you like about the market is the force with which Bank Nifty is looking higher. And there is definitely an angle of outperformance which is there in some of the PSU banks as well. I'm scanning through the F&O list right now. You got SBI right up there, Can Bank right up there. Cement is looking strong, little bit of metals here and there. Not a very vibrant market, but the fact that you've not slipped back to the lowest point of the day after that mid-morning scare just shows that there is a little bit of life in the market.
Oh, well, yes, and defensive seems to be the color of the day. Pharma and FMCG are two of your top sectoral gainers at this point of time out of the three, and PSU banking names, as we pointed out, is also doing quite well. However, autos continue to reel under pressure. 8-month low is what it has formed. Remember, we'll get the auto sales data at the end of the week, so that's something to track as well. But let's track the technicals of the market. We have with us Shivangi Sarda as well as Naresh Mirani joining us to talk to us about the technicals. Naresh, let me first come to you. Quite a bit of bounce back, and it seems to be sustaining for now. In the morning you were suggesting a hold call. Has that changed? Are you turning a buyer?
So it's still a hold. Say once we start sustaining about 17,200 on the spot basis, that is where you get a little more aggressive. And for now it's a hold on the Nifty as well as on the Bank Nifty. Good recovery seen, and we are seeing a decent recovery globally as well. So the setup is nice, but the momentum needs to catch up over 17,200 to actually become more convincing.
What's your take regarding Bank Nifty at the moment? It's of course at the highest point of the trading session, but still underperforming the headline index by just a smidge. Shivangi, can you hear me?
Yes, so talking about Bank Nifty, we've seen that there has been relative strength over here. Of course, even Nifty has been showing a great amount of support-based buying going up. Since the morning, we've seen that any bounces were utilized, and we've seen that there has been a good amount of run-up from from lower levels. So even though Bank Nifty was comparatively stronger in the yesterday session, today we've seen that it has still held on to its previous days levels, and we can see that it has surpassed its higher zone. So definitely Bank Nifty is also if it holds 39,750, we could go long on this towards 40,250, and 39,250 would be a crucial support to look out for.
Naresh, so are we in that one step forward, one step back kind of a market, or we are now in a market where you will walk forward, you may walk slow, you may not take a giant leap, but directionally it's no longer one step forward, one step back. It is now one step forward followed by one baby step.
Yeah, so we could actually be setting up for a trend which could surprise. So basically we've had a period of last 12 to 13 days wherein we've just been around 17,000 levels. Now, ideally, if it's a bear market, you should crack fast. You don't spend a lot of time at the same. In a bear market, which is sharp, there are sharp rallies also. So this has been a very sideways move for a 12 to 15 session. So this could actually resolve going forward towards the upside as well. So I would be more positive going forward, waiting for price action to confirm that. So that could be a big step going forward. So that could be a big move also if it sustains above 17,200. So overall, wait for more price action to confirm the logic.
We'll see whether we head towards that 17,200 in a hurry or not. But let me address some of the stocks which are reacting to news flow as well. Starting with Lupin itself, that's one of your top gainer. In fact, the entire pharma sector is holding out quite well. The Pithampur facility has been assessed by the UK MHRA, and they have got the inspection cleared without any red flags. So that's the positive news. Plus, they've got the FDA approval for a couple of drugs as well. So that stock high by around 4%. Phoenix Mills is the other one, wherein Morgan Stanley has initiated coverage with an overweight stance. They say that the company is likely to double its rental portfolio and is in a growth phase, and all of that augurs well for the counter, 3% higher. Metals too are in focus, wherein BofA has actually written a fresh note. They're constructive on the Indian metals and mining sector, seeing scope for steel price hikes, and that's the reason Tata Steel is their preferred pick at this point of time. In fact, other than that, Vedanta is also something they're positive on. Remember, there's a board meet tomorrow for Vedanta to discuss that interim dividend, so definitely excited ahead of that. And Hindustan Zinc is their underweight call. And lastly and quickly, IEX, that stock is coming under pressure, down about 5%. Remember, Dalmia Bharat has been talking about their divestment plans from the non-core assets, and IEX is one stock that they hold position in. It's already down from 20% to 15% thereabout, and they're likely to reduce the stake further and completely exit the counter. So the supply pressure is something which is building up for IEX, so a downtick of around 5%. Naresh, your word as far as the entire pharma pack is concerned, Sun Pharma, Lupin, Oro Pharma, they're all clearly very excited in the trading session. Is it a one-day move, you would believe, or even the likes of Biocon, etc., coming out of a bit of a hiatus?
So I would expect a little more bounce back because a lot of these stocks have corrected in a meaningful way. So if you look at a Lupin, it's corrected very recently from 780 all the way down to 640. So I would expect not just one day, maybe a week or two of recovery. But the leadership is clearly in stock like Sun Pharma, which has not corrected as much as the rest of the market, and has been holding on well above the last major support as well as the breakout point. So Sun Pharma could be the place where one could hide, but overall it's a bounce back trade. If you look at a Biocon, the stock has corrected one way all the way from being 490, 450, 490 in 2021 down to 190, almost back to COVID, below COVID prices. So that tells you that it is so oversold that even a 20% bounce back will look a very small bounce. So there could be more legs on the whole pharma rally.
Vari joins us, equity manager with Axis Mutual Funds. Anupam, good to have you on ET Now. Thank you for joining us. What is keeping this market perhaps jammed? The India story is strong. Valuations are no longer stretched. Flows are strong, but India is underperforming massively.
Yeah, hi. Thank you for inviting us here. See, there is too much of negative, or let's say negative surprises for investor to digest, I guess. Starting last year when war broke out, and then rapid interest rate hikes, and then the whole banking turmoil that happened in Europe and US, and we are still hearing the news. And one should also keep in mind that from third quarter onwards, there were chatter of moderate growth in India, growth moderation. And that's a very, very important factor that we have to keep in mind. And then the whole talk started about the bulging BOP problem. Of course, now we are seeing that the problem is not as great as it was envisaged to be. But considering all this, basically it created a lot of negativity around market, around investment for the investors. And they were not able to digest and make a comprehensive picture out of it when so many things are happening around it. So that's the reason, I guess, that's happening. Maybe it may take further 3 to 6 months when things become more clearer, uncertainty is reduced, and then it will shape up in a good manner.
What will take us out from this, the so-called range? Will it be earnings? Will it be something on inflation? What will change, sir? अच्छे दिन कब आएंगे? 1.5 साल से वही निफ्टी.
Happens, but before 1.5 साल, that 2 साल तोड़फोड़ पैसा भी बना था. So we have to keep that in mind also. So, things return to normal. You will always revert to mean that's the norm of the market overall. See, let's look at variables. What caused the problem? And one by one, as you get further clarity about that, I think we will get out of this rut. So first is what is happening to US in terms of interest rates. Being an emerging market, it is a very, very important factor for us. So that's I think the critical variable that we have to watch, and there has to be some clarity that whether rates have peaked out or not. And the problem is that all previous expectation that it has pivoted has gone wrong. So the US economy, especially the wage inflation, has remained much beyond expectation of any commentator. So that's a very important factor that we have to watch. The second would be how earning trajectory pans out in next 1 or 2 quarters. Because growth has moderated, and I think given the way BOP problem was being played out, everybody kind of wanted that, okay, let the growth taper out a bit. It's not a problem. So I think that would be another variable. And then, every bear market or every negativity around market creates its own trajectory of positivity. So as you said, once valuation starts looking attractive enough, automatically market will start doing well, even if, the earning trajectory is slightly far ahead. So I will not say there is too much to worry. It's a grinding market, yes, but that's the price that you have to pay in the market to make money out of it.
Anupam, last year was all about banking stocks and auto stocks, which massively outperformed. This year, they haven't had a great start. Is this a year where there's going to be, again, a lot of sector churn and the underperformers will come out as outperformers?
Yes, if economy improves, yes, banking as a sector will do well because valuations are very, very reasonable. And of course, there are concerns about whether NIMs at such high level will sustain or not. But if growth is there, I think still earning growth would be there. Balance sheets are very, very strong. So I'm sure that the whole underperformance that has been there for the last 2-3 months will go away and banks will start performing again.
Okay, on that note, we'll step into a very short break with the news that the market is easily sustaining that up move. 17,070 is where we are at the index level. Just a bit of a worry on the broader markets, but we'll track that for you when we come back. Don't go anywhere. Welcome back. 200 points higher when it comes to the bank Nifty as well, so definite pick up there as well as Sensex up a good 400 points. The sectors continue to be Pharma, FMCG, which continue to lead the rally, and metals are definitely shining in the trading session as well. Talking about metals, Vedanta has been one stock which has been fairly volatile of late, has been in the news of late on the back of several updates on its debt as well as repayment. While promoter and chairman Anil Agarwal hopes to make the group a zero debt company, note that it has almost 2 billion worth of bonds to be settled in 2024 alone. What's the road ahead for the company and how do they plan to manage the debt picture better? Let's go across to my colleague Anurag Joshi.
Yeah, so mining to oil conglomerate Vedanta needs to repay nearly half of its over $2 billion of bond and loan obligations by the end of May. So the conglomerate needs to pay a little over $2 billion of bonds and loans this year. And significantly, in April, there is a $400 million bond obligation coming up for repayment, following which on May 31, there's another $500 million bond obligation. Another key payment for the company would be in early 2024, in Jan 2024, when it has to pay back $1 billion of bonds. And this is the bond, for which the company had tapped many credit funds and had raised this money at a rather high coupon rate of 13, almost 14%. Now, if we look at the debt maturities for this year, it's about over $2 billion, and in the coming year, this is going to be more than about $2.6 billion for Vedanta. Now, recently, the company has has started talking to lenders and investors for raising money for refinancing, though the progress of these talks are still not, it's still early and it's still uncertain. In fact, the Economic Times earlier this month had reported that one of the units of Vedanta Limited, which is THL Zinc Ventures, that has been talking to lenders for $1 billion loan facility and is even looking to raise this money from credit funds. Media reports recently had quoted Anil Agarwal as saying that he wants to make the group a zero debt company and has been talking to foreign lenders, notably JP Morgan, for that $1 billion of funding at around 8 to 10% interest rate.
That's a take coming in on Vedanta. Thank you so much, Anurag, for bringing that into the perspective as well. But let's look at some of the stocks which are bouncing around. And Reliance definitely deserves mention, 2.25% higher. You also have Grasim, which is the top gainer at the index level, 3% gain coming in there. Though it's autos which are on the back foot, so Tata Motors is down 1%. M&M, of course, on account of that downgrade coming in, is down about 0.6% as well. But one space which is doing quite well is the entire healthcare segment. So, Anupam, your take as far as pharma is concerned, would you be looking at buying into some of these counters? And if yes, which space? Is it going to be hospitals? Is it going to be diagnostics? Is it going to be your generic pharma makers? Which space are you, inclining towards?
See, currently we are pretty bullish on hospital space because there we see more possibility or let's say high probability of consistency in earnings. It's one of the very good unorganized to organized story in India with per capita income going up, insurance penetration going up, the affordability is going up. And that gives us a lot of confidence on the hospital story per se. And on the other side, if you look at generic, etc., I think competition is increasing a lot, even in India now. Earlier, the high competitive intensity was in US, and hence ROEs were under pressure. So that may continue, and hence material re-rating may not be possible for these companies. So preferable bet for us is hospitals as of now. Of course, we will evaluate as and when situation comes that valuations are attractive enough. But domestic focused would be a better choice in our opinion.
Hospitals. Well, some of these hospital stocks have really hit out of the park. A, COVID, B, healthcare, C, more healthcare insurance, and then perhaps a real tilt post-COVID in terms of quality healthcare. Anupam, everybody's bullish on hospitals because everybody's buying more healthcare. But if I look at the insurance companies, especially the non-life insurance companies, they are not growing. It's quite ironical, right? The thesis is Indians will buy more insurance and healthcare as a sector will grow because you want better healthcare. But the insurance sector per se is just going through an extraordinary struggle, whether it's life or non-life.
See, market is a very complex system. Any economy is a complex system. So you cannot, always create A plus B is equal to C kind of equation. To give you a perspective, in last 20 years, maybe infrastructure sector has seen the highest revenue per se. But there are not many companies who created huge amount of wealth for investors. So if sector is doing well and there is demand, there is revenue potential, the revenue pool is high, it doesn't mean that companies will create investor wealth. There might be competitive impact, there might be pricing pressure, etc., etc. Revenue may still be growing. So that's the reason. The difference in, let's say, pure insurance or a hospital is that the operating leverage for a hospital is very high, the pricing power is very high, and hence sustainability of profitability is good. Secondly, India is moving in healthcare from, let's say, semi-organized to fully organized space. And that's a better reason for us to be positive on hospitals because the availability of talent for smaller hospitals, maybe you have seen in, smaller cities, 15, 20, 50 bed hospitals, they are not able to afford good talent. They are not able to afford provide a holistic 360-degree healthcare, etc. And the government sector is struggling in terms of providing good healthcare. And people want to now have good quality healthcare. So, and we are also aging. We should not forget that we are aging, and that's one more reason that you need more critical quality healthcare. So that is a better, in my opinion, that is a more compelling reason for us to be in hospitals rather than anything else.
Narayana Healthcare, Krishna Institute of Medical Sciences are some of the stocks in your portfolio, at least the small cap portfolio as such. But Anupam, in your this small cap growth portfolio, you also have a lot of chemical names, Galaxy Surfactants, Fine Organic, a lot of other names as well. What makes you bullish on these counters, and what's the rationale for selecting some of these?
So chemical is a very, very big space globally, right? And even in India, it is one of the oldest sectors. You can count some of the chemical companies are 50, 60, 70-year-old operating in India. Some of the companies that we own are actually more than 30-year-old. They started 30, 35 years back, and then they have grown. What we look and in this sector is that companies should have some kind of niche or some kind of good capability that gives them a differentiation. We are not essentially looking for something like China plus one, etc., etc. We are not sure whether that would be a very scalable proposition or not. How long, how profitably we would be able to compete with Chinese companies. It's still unclear. Of course, there would be revenue, there would be potential, there would be opportunity. But what we look for is that can these companies, is there any company which can grow on its own merit, on its own capability, and it should have a global competitiveness, not just locally. So the companies that we own, most of them are globally competitive. They supply not just in India, but they have a decent market share outside India. And given their spend on R&D, given their product development history and their cost advantage, they have a very good potential for further market share gain globally. And that gives us confidence. That is how we evaluate and own the companies in this space.
Let you go on that note. Thank you so much for joining us and talking to us about the top sector bets that you have at this point of time. But Shivangi wanted to come back to you and discuss Reliance. That stock is on a tear, is adding almost what, 1/3, 1/4 to the Nifty gains today. Is it heading higher, you believe?
Absolutely. So Reliance has been one stock which is driving the market since the morning, and we've seen that there has been quite a lot of up move over here. A lot of short build up can be seen, which is driving the market from these levels, and we've seen that the previous hurdles are also being crossed, and from these levels we expect that it could go to around 2340 levels, and support near 2200 levels would be an important level to watch out for.
I go back to that very basic question once again, Shivangi. Next 10 days, will long trades make more money or will short trades make more money?
Absolutely, Nikunj. So we've seen that the market has taken a good base near 850 zones, and it is not crossing those levels. Now, if we talk about the next 10 days, we have the March expiry day after tomorrow, which is expected to be quite volatile. Given the scenario that volatility index is also at quite higher zones, and it is not cooling off from those levels, which is giving some sort of a pressure to the entire market, with a lot of volatility which we are facing from the global bourses as well. Now, index FII's long short ratio is also quite low at its lower band, around 12%, and which indicates that somewhat selling can be seen. And even though we are seeing bounces, the absence of follow-up buying at higher zones is making the index again sink down. So somewhere this range is going to act out for the index for the next 10 days, and we could watch out for 17350 on the upside, and on the downside 16850 would be crucial to watch out for.
Thank you so much for joining us today. Appreciate your time. But with that, slipping into a very short break, Nifty is off the highest point of the trading session. But we'll see whether this is something to get worried about, or is it just a bit of a sideways move. We'll track that when we come back.
Well, thanks for staying with us in conversation with Deepak Shanoa and technical experts. And just when we got excited that today India will outperform, the selling comes. And the selling is, I think, evident on your screen, which is that we are racing towards 16,950. So the mid-afternoon flourish has been sold in 100 points off from the day's high. Deepak Shenoy joins us now. Deepak, this will bring a smile on your face. You want to guess what will I talk about?
I would imagine. I think I know exactly what you're going to ask.
Anisha can guess it is Reliance.
Well, it's
Did you
Reliance.
hear the
and
music?
LIC.
Did you hear the music also in the background? That is Anisha saying, I guessed it will be Reliance.
I didn't. Yeah, I can tell you a little bit. I mean, we were talking about it recently about how Reliance is this mega play on pretty much everything that seems to be happening in terms of FMCG. They're buying designer clothing brands. They're getting into a bunch of FMCG applications. And it's one of our largest positions. So we're intrigued. But you know what the difference is right now is competition in this space is a little more difficult for the startup crowd because they can't raise funds fast enough to compete, and for maybe some of the other brands also, because raising capital at this time, both debt and equity, is going to be incredibly difficult. So someone with cash, someone with the ability to raise debt because they have a fairly good view on a fairly good impression in the debt market. I think this is where Reliance can shine. Now, having said that, a lot of potential in the past. We are biased because we own it, and we haven't actually seen the stock price demonstrate anything, and the earnings also have yet to show, to be honest. So I'm hoping the next 3 years are going to be much better than the last three have been, and less dependence on oil revenues to fuel future growth.
Yes, it might be good news because of the expansion coming in for Reliance, but it's a bit of a negative news for Nykaa, which is coming under pressure. Of course, there have been a lot of high-level exits as well, and given the fact this entire space is expanding with a lot of new players coming in, that's pretty much par for the course. 3% lower for Nykaa as well. And today there was news flow around Mamaearth as well, wherein there is this talk whether the IPO will be put on hold, or are they going back? Are they waiting for the final approval? So bit of chatter around that as well. But just coming back to the markets, because now we are losing quite an accelerated pace. In fact, look at the Bank Nifty, pretty much wiped off the gains of the trading session. The last time we spoke, there was a gain of almost 200 points, and now we are just flat with a minor gain of around 40 to 50 points. Bandhan Bank is your biggest loser. You also have Axis Bank, ICICI Bank, which have turned for the worse, and HDFC Bank and Kotak Mahindra Bank too have narrowed their gains. Even for a Nifty, Reliance is considerably off the highest point of the trading session. Deepak cuts coming in for M&M as well as Tata Motors. In fact, the auto space as a whole, Deepak, has been underperforming for a while now. And there is a downgrade coming in on M&M this morning from one of the brokerages as well. Would you also concur with the view that perhaps one should book the profits in some of these names?
I think so. We own a bit of M&M, so there is some bias here. But M&M is actually more a more diversified play within auto because it has both commercial vehicles and SUVs and so on. But there's also the other arms that they own. They own a bunch of engineering arms. They're a bit more into defense as well, and engineering and other parts of engineering. And then there's the holdings in some of the other businesses, including holidays and life and Tech Mahindra as well. But by and large, the auto play, I think, we've seen about 5 years now since the auto industry has kind of been, struggling in terms of sales. M&M has actually got a benefit in the last 1 year because SUV sales were relatively higher, but the industry overall did not do so well. I think the next 5 may actually be a change. We're seeing much better infrastructure coming up for both road and rail transport. Road transport becoming better will be good for both commercial and for passenger vehicles. We also think that once we go through this wave of high interest rates, that the next era will actually help a lot of these auto companies and people to come out, to be able to borrow to buy vehicles, both personal and commercial, in a better way. So the next few months may be a little tough, but I think the better times for auto are going to be ahead of us. But you got to plan carefully. This is a tough time to say buy anything because everything seems to be falling the minute you say it.
I wanted to highlight the market breadth because that's clearly worsening. Let's pull up the small cap index as well as the advanced decline ratio. So we have almost 1700 stocks declining at this point of time versus 500 stocks advancing, and even the mid cap index is down a good 0.5%. And yes, it's a broad-based, downfall that we are seeing in the last few minutes. A lot of stocks are trading at the day's lowest point, whether it's ACC, whether it's UBL, Siemens, all of these stocks are trading at the lowest point of the trading session. Naresh, wanted your take. The up move was led by the large cap names. Is that going to be the trend? And mid caps and small caps will likely underperform, at least in the near to immediate term?
So generally what we see is in the bottoming out phase, we see in the end small caps take a panic fall, and it is first the large caps which make a recovery. So as of now, for the next few sessions going forward, we should be first watching a recovery in the large caps followed by small caps. And the small cap index has broken the recent 52-week lows, very closer to that, equivalent to the 16,800 mark of the Nifty has been broken down. So we could expect some more pressure to continue for a couple of sessions, but this is the time where you get good opportunities in the small cap, provided you are an investor who can digest another 8 to 10% after buying the next day itself.
Rajesh Palve, what do you make of today's price action? It appeared that we were taking a baby step towards the upper end of the range, but things have come cracking down.
So throughout the series, 17,150, 17,200 acted as a resistance area. And again, the same behavior we are seeing in the market in the last half of this expiry. So looking at the data, looking at the call writers activity, still they are there at 17,100, 17,200 strike. They're not covering their position. But on the other hand, 16,900, even 17,000 is having put base. So looking at the data setup, we believe that it's going to be very range bound session for next couple of trading sessions. 16,900, 17,200 could be the possible range going forward. And the major part where we are seeing focusing is the banking stocks. So banking stocks tried to recover in today's session also, but again, as Bank Nifty is having major resistance at around 39,700, which is very challenging for the Bank Nifty to cross at the current level. If Bank Nifty manages to cross those levels, then some of the stocks like SBI, ICICI Bank, these are all looking attractive at this moment, and we can see some short covering action to play in the Bank Nifty. So Bank Nifty could give some recovery from here onward, and possibly Bank Nifty can manage to give breakout above 39,700. That is the level to watch at the in the next 1 or 2 trading session. But the Nifty, we believe that it's going to be range bound for some more time.
Okay, Nifty is going to be range bound for the next few days. We'll try and repatch that line with Rajesh as well. But in the meantime, let's address some of the stocks which are basing on price volume action. Reliance is, of course, one stock which has gotten this support at March month low on a monthly time frame basis. So that stock is holding with a gain of 1.3%. IEX, on the other hand, is breaking down from an upward sloping support trend line. It's been declining for 7th consecutive session, has slipped below the 50 and the 100-day moving average. And today, of course, the news flow about Dalmia Bharat looking at selling some more stake in IEX is keeping that under pressure. And Cipla, lastly, which has snapped the 8th session streak of forming lower highs, forming the bullish candle after the hammer candlestick as well. So some of these stocks are definitely interesting, but a lot is happening on the policy space when it comes to the power sector as well. The question is India prepared for the searing summer going ahead? Is Centre ready to make the surging power demand, to meet the surging power demand as well? Because there have been a lot of notifications which have been issued with respect to managing the coal inventory, etc., and ensuring blending. But what's the latest? Let's go across to Prakash to understand that better.
See, the Power Ministry has written to all states and union territories on distribution of domestic coal based on a formula. A strategy has been prepared by the Power Ministry to supply domestic coal to all central and states generation companies along with independent power producers to meet unprecedented power demand during this summer. As per the Power Ministry, availability of domestic coal is lower than the overall requirement of domestic coal during month of April to June 2023, mainly because of constraint in railway logistics. As per the Power Ministry, availability of domestic coal is just 201 million ton against of overall requirement of 222 million ton in first quarter of the next financial year. Considering that Power Ministry has prepared new distribution policy for supply of coal to the generation companies. As per the Power Ministry, domestic coal would be allocated in a ratio of fortnightly average generation by generation companies. Coal required by all pitted power stations of respective generation companies would be excluded from this distribution policy. Apart from that, coal to be made available from captive mines would be excluded from allocation of railway rakes from CIL and SSCL. Apart from that, rail rakes of states would be reduced accordingly if it is found that states are selling power generated from domestic coal in power exchanges, on notified rates. Rather than that, as per the Power Ministry, surplus power would be made available to other discoms through a government portal. This new distribution policy is going to be implemented from 1st April 2023.
Deepak, how do you see this entire coal and power pack moving in this year? Inflation is significantly lower than what it was. These stocks are no longer the underdogs. They have been the outperformers in the last 1 year. Is there still money to be made in, let's say, Coal India, NTPC, Power Grid?
To be fair, I don't have a lot of exposure here. We're not very positive here. We don't find an attractive investment proposition in Coal India specifically because there'll always be money to be made in Coal India from a dividend perspective. It's just that the growth perspective is always going to be a little bit of a problem given prices, given our move to it's a monopoly, but the restriction on prices is that you can't price things the way you want to because otherwise power in India becomes extremely expensive. So you don't have pricing power and you don't have major mechanisms for reinvestment either. So, but there might be some players in here that look interesting. There are some baby steps being taken towards nuclear, towards increasing the solar footprint. So maybe that is something that is interesting. However, some of these stocks are priced at the higher end of their historical ranges. And given the interest rates the way they are now, companies like NTPC, for instance, will see a higher, relatively higher, and Power Grid too, relatively higher interest cost hit them in the future. So I would say right now not interested, but perhaps if the prices were to correct more, some of these could get attractive. We have nothing in here right now. I don't have any deep analysis to share.
Okay. Naresh, first let's understand today's decline and what it means, because we're almost closing at the lowest. I mean, we're closing not at the lowest point of the day, but almost at a break-even level now.
So today, what we are seeing is the last 15 minutes, like between 3 to 3:15, we've seen a quick crack of 60 to 80 points. Could be some bit of a readjustment because we are not seeing a similar crack happen in the global indices as such. And all through the day and the last few almost 10 to 12 sessions, Indian indices have been following the global indices. So today seems like an odd one out again. But till the time we are in this band of 16,800 to 17,200, this volatility would be normal, one day up, one day down. Once we start sustaining beyond these two prices, that is where we start looking out for more price action. So for now, the bias remains positive till the time we are above 16,800.
Quite a massive fall, and yes, to the point that you were alluding, the global markets are in a fine fettle at this point of time. You have the German DAX up 1%, FTSE is up 0.5%, French CAC is up 0.8%, and even the pre-market rates from Dow are quite strong, an uptick of almost 100 points coming in on the Dow futures. So clearly, it's not the global nervousness, at least at this point of time. Not sure if we are preempting something which is going to happen, but for now, we are falling alone, and even Asian markets had ended with a decent amount of uptick, so we are falling alone in isolation as far as the Indian markets go at this point of time. But Rajesh, would you like to venture a buy at the current level after this fall? Would it become a good risk-reward play, or would you still stay away and wait for the poison to get out of the system per se?
So we are focusing on stock specific and some of the stocks which are already trading above their near-term breakout level. So the first stock is SRF from the chemical space. Stock has managed to give breakout of its previous swing high, and now stock is trading above all its near-term, short-term moving averages. In today's data, again, long built-up is there for SRF. So we believe that SRF can exhibit furthermore upside from the current level, and one can buy this SRF for upside target of 2450 to 2500 in the continuation of this uptrend. One can place a stop loss at around 2340. Another stock which we like at current juncture, that is Grasim. In today's session, stock is now penetrating its 50-day, 100-day moving average, and now stock has given a breakout of its previous swing high of March series itself. And the open interest is also added on the long side. So looking at the long built up and the breakout above 100-day moving average suggests that furthermore upside we can expect in Grasim in coming trading session. So one can buy Grasim also for upside target of 1720, keep stop loss of 1610. The third stock which I like, that is Alkem Laboratory. Stock managed to give breakout of its falling trend line on daily chart, and looking at the breakout and the kind of open interest addition, we believe that Alkem Lab can move further higher from the current level, and possible target in the continuation of this uptrend could be 3350. One can keep stop loss of around 3170 to go long in Alkem Lab. These three stocks are looking attractive.
For giving us your stock-specific recommendations, but markets have completely fizzled out, completely flattened, 16,950. Deepak, you've been quite vocal about the entire amendment coming in for the debt mutual fund as well. While things seems to have stabilized for the other counters, today Aditya Birla Sun Life AMC is down a good 8%. I was looking if there was a corporate action. It's not the case, not going ex-dividend or anything today. But the stock is down 8%. What do you do with the AMC stocks now?
So there is actually a concern in the sense that there's about 3 lakh crores of AUM under a little bit of stress, because while they may not lose a significant amount of AUM, I think what we might actually see is incremental AUM coming into some of these funds may not come as easily as they've come last year, because many of these funds are sold specifically to retail and HNI with a fairly strong emphasis on the taxability advantage over say a 3-year or 4-year basis. Now that taxability advantage has reduced, it's not gone completely, but it has reduced. We are going to see incremental AUMs coming in lower. Now, a lot of these debt funds, Birla, for instance, has a medium duration fund in which they are able to charge as much as 1.35 or 1.38% for a regular plan and 0.86% for a direct plan, which are competing with equity level AUM management fees. These are these will reduce their revenue going forward because without the tax advantage, inflows may not be as strong as they might have seen earlier. Given this, I think the AMCs will have to rethink their strategies on debt, and perhaps the corporate bond market will see higher yields given lower participation, lower demand in the coming months, and therefore they will have to compete on yield and in terms of effective yield to customers, lower fees as well. But I think AMCs in general are a very good business. The only problem with them is they can only do the AMC business and nothing else. So even high ROEs cannot be reinvested back into the business because the business doesn't need money to grow. So that's the only issue with the AMC business. So it may be a more valuation issue than it is solvency or a serious hit to profit in the longer term. But I think they'll eventually find their value.
I assume that the valuations would have become now reasonable given the massive correction some of these counters are seeing. But for now, the participants and investors are not willing to take that bait. But Deepak, if I had to ask you to tell us one stock or one space which looks a very strong, high conviction buy at this point of time, what would that be?
To be honest, it seems like artificial intelligence seems to be the call of the game. We don't have any players here at all meaningful in India, but I think that is a game-changing sector. We'll have to see who among the public companies even begins to come into the radar. But that is, I think, a big field. Don't have a company there yet, but that's what I'm really looking at in terms of how that can change things. But I'm still quite bullish on certain companies. A company like Reliance, I think all of its fields, whether it's telecom, the oil refining business itself, and the oil to consumer business, and the retail business, I think are poised to grow quite substantially. We're invested, so fairly positive on that. But I think if you look at just domestic consumption and import substitution as a theme, that is the area where we'd like to really focus on in the next few years. India will not be an export-led model, but it will reduce imports by having to giving more incentives to manufacture locally and for local consumers.
Okay, so consumption and then the mega trend of AI, but just winding down for the trading session, 2 minutes left. So Naresh, quickly, what are your BTST ideas?
So going only with one now, was expecting a bigger bounce back. So first is a buy on SBI itself. The stock is struggling around that 500 mark. 508 is the price point right now, which is a stop loss. But 500 has been the low for the last few weeks. Expecting a bounce back from it.
Let's see whether that bounce back happens or not. But thank you, gentlemen, for joining us today and wading us through this volatile session. Volatile is exactly the way to kind of depict what happened today, because we are firmly in the green, trending high, and everything seeming to be falling in place for the markets when we were at 17,100 thereabouts. But a complete U-turn and ending pretty much flat for the trading session have fizzled out a rally of almost 100 points on the Nifty. The Sensex too going home with a gain of just around 50 points. The mid-cap index and the small-cap index, that is where the pressure was today. So the broader end of the market clearly underperforming today, and massively at that, and even the market breadth clearly favoring the declines as we speak. Sector-wise speaking, we started off well, and there were a lot of sectors which were trading in the green, but it's remained just a handful. There are 3 sectors which managed to end in the green: Pharma, FMCG as well as IT. Other than that, it's auto on the back foot, banks on the back foot, and the PSU banking name as well as metals, which were shining earlier, have completely taken a turn for the worse. From the pharma space, Biocon, Glenmark, Lupin, these are some of your top movers. From FMCG, it was Dabur, HFCL as well as ITC, which was having a field day. And then, of course, cannot forget what was happening with Reliance, because that heavyweight was definitely powering through a gain of 1.6%, and Grasim too ended the day with a gain of around 1.9%. From the broader markets, Minda Industries has a good day, 4% higher. Estel Propack was quite excited throughout the trading session, 3% higher. Phoenix Mills was spurred by that note coming in from Morgan Stanley, wherein they have initiated with an overweight stance. And talking about the brokerage action, such was the case with Kotak Mahindra Bank as well. A CLSA upgrade coming in there. And quickly wrapping up with some of the losers, Aditya Birla was down 8.5%. Trident down a good 7%. IEX, as Dalmia Bharat is looking at cutting stake, was down 6%. And PNB Housing, Sonata Software, some of your other top losers, cuts of anywhere between 5 to 7%. So I have to say, there is this nervousness in the market which is clearly visible. Confidence is lacking and the momentum has just shifted. So we'll have to track that very, very closely when we come back for the trading session tomorrow. But for now, it's a wrap from the closing trade team.